Today I'm joined by Rhiannon Sowerbutts, the author of the paper Bank Liquidity and the Cost of Debt. First, can you describe the context of your publication?
So global liquidity requirements are a relatively new development. They kind of came into place after the global financial crisis, where a lot of banks failed because they didn't have the liquidity to keep funding themselves after lots of investors refused to fund them anymore. Even though a lot of banks that kind of failed or got into difficulties were reasonably solvent. But liquidity requirements have come into a fair amount of criticism. So liquid assets don't really yield very much compared to things that are more illiquid. And so there's been a lot of criticism that it's making the cost of maturity transformation, which is a fundamental thing that banks and other financial firms do, more expensive. And it also potentially means that they're doing a lot of less lending because they're having to hold kind of liquid assets such as sovereign bonds instead of lending to households, etc. But we think that there's potentially an important factor that people have neglected in this criticism. And this idea is that, well, if liquidity requirements mean that a bank run, like we saw in 2008, is less likely, then that means that the bank is safer. And that means investors should ask for a lower premium on their debt to invest in the bank. And this means that if the cost of these liquidity requirements might actually be lower than a lot of people think.